So before I introduce Peter Barnes from QBE, who's going to be the chair for this afternoon's event, I just did want to give you a quick history lesson. These events, our Corporate Tax Managers Network events, commenced in about February 2011. Dan Ross, who at that stage was head of tax for CSC in North Ryde, got together with Head Hardwick from our team and created the concept of the Corporate Tax Managers events, mainly because Daniel was lamenting that he really didn't have an opportunity to get together with similar executives to talk about tax issues, compelling tax issues. We organised the first event at the end of February 2011. We had Dick Warburton, who was at that stage was the outgoing chair of the Board of Taxation. He spoke at one of his last events. We had about 40 or 50 members of the network in those days, and now we've reached just over 2,000 members. And one of the characteristics of these events is that we run based on the involvement from the members. So any events that we run are based on the input we receive from heads of tax and similar roles, based on what you find is interesting, what you want to hear about. So part of your pack you'll see on the chair is a feedback form. Now we want feedback not necessarily about the sandwiches and the orange juice, but more about what topics you'd like us to cover. Even though the sandwiches were good, but we do want to hear about what topics you want to cover, and then we go out and we source keynote speakers, whether it's from the ATO, from the Big Four, or some other keynote worthy individuals. Some of you may know that in the past we've had a couple of very high profile speakers who've gone on to bigger and better things. So one of those speakers was Matthias Cormann, who's now a member of Cabinet, Finance Minister. The other was Chris Jordan, who's obviously kicked on to a bigger role. Now we're not claiming all responsibility for those promotions, but clearly it's all about satisfying the needs of our members of this network. So before we run out the door this afternoon at the conclusion of today's session, we do ask that you take a few minutes to complete that feedback form to give us an indication of what upcoming topics you'd like to hear. So with that, I'll pass over to Peter.
Thanks very much, Russell. It's wonderful of CCH to host this thing because it's a very good opportunity for everyone to learn a lot more about tax, the wonderful field of tax. You've all got the introductions for the speakers in front of you, so I won't labour that too much. You can read that all at your leisure, because we'd far prefer to hear from our speakers, particularly Karen Anstis, who's an Assistant Commissioner with the ATO. And I thought at this stage I'd introduce the rest of the panel as well. So Karen's on this end. Moving along from Karen, you've got Mark Tafft from EY, Jacqui Hardwick from KPMG, Denis McCarthy from PwC, and Rodger Muir from Deloitte. I think the person we really want to hear from is Karen, so without further ado, I'll welcome Karen to the stage.
It is something that we actually value doing. It's something that we frequently obviously get invitations to speak at various conferences and things like that, and it is a very important opportunity for us to be able to talk with you and share with you some of the things that we are doing. I also want to point out that for some of you, the topics that we will cover today will be things that you're already familiar with. For others of you, you won't be so familiar with parts of it. What I'd like to do is ensure that at least all of you get something out of the presentation. I do also want to mention that in relation to our compliance program, we now have an online publication this year on our intranet, which was previously published in hard copy, which is our annual compliance program. This one's called Compliance in Focus 2013-14. So on some of the risk areas that I will briefly mention today, there is actually more information in this booklet available on the website. I'm not sure how many of you actually get to see it or even are aware of it. We get mixed feedback about whether people actually know about it. So I did want to draw your attention to that. I also want to draw your attention to another publication very relevant to the large businesses that is also published on our website this year. I've got a copy from last year, which was in hard copy, but this year it again is online and goes through in a lot more detail our whole of ATO approaches to the large market. So if you haven't seen those documents or referred to them, I would encourage you to do that. I need my pointer, sorry, just a moment. Okay, so the topic of our presentation today is it's a Tax Manager Network GST update. In today's presentation, I'd like to briefly outline our large market strategies, the risk differentiation framework, our expectations of governance and tax risk management, and some of our key GST risk areas that we're going to be focusing on in the next year, including our integrity of business systems risk, financial supplies risk, property and base erosion and profit shifting work that we are doing. In doing that, I think it's important that I also share with you some key facts about the market. Again, these figures we do publish in various documents, so they shouldn't be that new to you. I also want to talk very briefly about our tax gap analysis. Again, there's much more detail on that published in the ATO annual report. I wanted to discuss some of the compliance drivers and behaviours that we observe and provide you with a bit of feedback on some of the work that we've been doing in the last year, and also, as I said before, discuss some of our approaches to our compliance risks moving forward. Okay, most of you will know that we have around 1,300 economic groups comprising over 32,000 businesses. In the indirect tax world, we also have an additional population that we're working with, which comprises of 800 large government entities. And all of that together, that large market, as we define it, accounts for around 50% of annual GST collections. Our approach to working with the market recognises that, by and large, most taxpayers are wanting to comply, willing to comply, and do in fact comply with their GST and other indirect tax obligations. So in that sense, in our business, we very much tailor what we do and our strategies in recognition of that. We have a very strong emphasis on service and also on assurance and enforcement. Now, I want to come back to talk a little bit more about our approach there and how that aligns to RDF in a moment, or risk differentiation framework in a moment. In terms of the tax gap, those of you who have paid attention to this will know that in our published material we have estimated the GST gap at being about 5.4%, based on our best analysis of a whole range of different data and information which helps us to get to that figure. What we have also acknowledged is that the gap has declined since 01-02 in the early days of GST, when the gap was around 8.9%, and the gap has been broadly steady since 2005-06. And indeed, we're not expecting great changes in that from year to year at the present time. I do want to also say that our active compliance results have assisted in reducing the size of the gap, and we have looked at quantifying that. And what we have found is that without direct active compliance, the gap would be around 10.7%. Now, Australia compares very favourably with other jurisdictions. I saw some bar charts last week on this, which showed our relative positioning in relation to other jurisdictions, and we do compare quite favourably in what they are estimating as being their tax gap in VAT GST. There is some more detailed information available on our website on the methodology, which is available for you to have a look at if you're interested. The methodology has been looked at by a number of people who have gone through it, and we're quite confident with the methodology that we have used. Obviously, we will continue over time to refine and further develop that work, particularly as we get access to more information and data. In terms of our compliance approach, what I wanted to say is that in the large market, we do have different strategies to what we apply in the SME and micro markets. And part of that is because we recognise that the large market is generally compliant, generally better resourced, a more regulated market, and so therefore our compliance strategies need to be appropriate in working with the large market. The risks that we tend to work with do mostly manifest across all markets, but they will manifest in different ways, and what we try to do is tailor our approaches accordingly. Our approaches have also been influenced for the last 3 years or so with our implementation of the risk differentiation framework. What we have done, most of you will know, is work very closely with our income tax colleagues on implementing that framework. What we found very early on in the first year is that we needed to be able to then align what we subsequently do once we have written out to taxpayers and provided them with information on their risk categorisation as we see it. We then worked to align our compliance approaches to that. And very early on, we recognised that we needed some new approaches to recognise that there were areas where we needed a level of assurance, but without needing to use our traditional enforcement approaches. I will be talking a little bit more about our approach to workshops shortly, but I did want to emphasise that that's been a very significant part of the change in our general approach to the large market, in that we now have around 5 assurance products. They are designed to be lighter touch. They are designed to be products that we can work with you more collaboratively and hopefully reduce the cost of compliance accordingly. So I do want to emphasise that's been a very important part of it. So those of you who perhaps don't understand why we started doing some things differently, it's very much in accordance to aligning our interactions with you according to the risk categorisation. In terms of governance and tax risk management, you will also be aware that a couple of years ago we published a guide and a checklist on the website for the large market. We've subsequently published a guide for the SME market with 2 checklists, and we're in the process of finalising a guide for the government sector as well. The importance of governance and tax risk management really goes without saying, but I do want to emphasise that it is a key leverage point for us and is very central to our whole approach to compliance in the large market, and indeed increasingly so in other markets as well as we move on. Our expectations around governance and tax risk management are spelled out at a high level in the guide and in the checklists. But essentially what we're looking for are policies, standards and procedures being in place and being able to be evidenced within organisations. We're looking at controls working effectively and all the processes that go around that, ensuring regular testing of controls and that sort of thing. Processes for identifying and reviewing risks within the organisation, particularly those risks which drive some of the other risks that we see, such as major structural change in organisations. We look for advice being, evidence of advice being sought when there are large or unusual or complex transactions which may not be day-to-day occurrences within the organisation. And we also obviously look for all the other reporting and sign-off processes being in place with clearly articulated roles and responsibilities. We also look for examples of when mistakes have been made, that there is evidence of voluntarily disclosing those errors. Now, there is, again, more information, as I said before, on our website in relation to the Governance and Risk Management Guide. Some of the key questions in there, I'll go through. Some of you will be familiar with these, of course, because you've worked with the guide. Are you confident that your organisational structures dealing with tax are sound? Are you confident that your organisation has well-documented policies and procedures on tax issues? Are you confident, again, that any computerised accounting system your organisation uses correctly codes and calculates the tax transactions? Are your tax functions independently reviewed? Are you confident that your practical obligations regarding tax registration, lodgement and payment have been completed on time? Now, as you can see, in the way that we've worded those questions, very much we've designed the guide as a self-assessment tool. And we hope that you are able to use it in that way. Since publishing that guide, we have gone on to use that guide and the associated checklists as part of our workshop program as well. Okay. I want to give you some feedback on our 2012-13 assurance workshops. As I said before, the assurance workshops are an important part of our approach to aligning our interventions with what our view is of the risk categorisation of the taxpayer. And what we've done is implemented those now. We're into our third year. First year was very much a year of testing and piloting, learning from experience and improving our approach to the assurance workshops. We have two types for those of you who haven't been exposed to them. We have a governance workshop and a risk workshop. The risk workshops tend to focus on specific risks or issues, where the governance ones focus more broadly on our guide and our general desire to understand the governance processes and assure them within the organisation. What we have found is that, particularly in the last year, we're starting to see some real benefits coming through from those particular workshops. 50% of workshops have led to specific action for follow-up, which has been agreed with the taxpayer. 14% have resulted in voluntary disclosures. 12% have led to further casework, and 6% of workshops have resulted in escalation for technical position. I'm just going to grab my water, thanks. Sorry, I'm just feeling a little dizzy. I don't know whether it's the lights here or what it is, but just acknowledge that I'm feeling a little woozy at the moment, so hopefully I won't fall down. Okay, I've covered off the risk differentiation framework. I think I am going to actually need to sit down for a moment. I'm very sorry. Yeah. Oh, yeah, I'm sure I'll be okay.
When you're ready, talk.
Okay, thank you very much. Okay.
Did you guys want to say something so far while Karen has a chance to regroup her?
We didn't plan on this.
No, we didn't.
I guess I'll start off just while you... The trouble is I'll end up making observations and asking questions. It seems to me that what we're seeing over a fairly graduated period of time is a greater ATO focus in on specific areas, specific technical risk areas, and then those are addressed by specific teams. And then there's the big question, which is the assurance around systems, and that's one of the key focus areas for the year. If I look at those focus areas, integrity of business systems versus financial suppliers, real property, base erosion, the latter three are very much ones where you've got a fair idea of what it is the tax office is coming after. When it gets to integrity of business systems, however, yes, it's a focus, and yes, there are expectations around, there are nice statements like controls are working effectively, and there's a process for identifying and reviewing risk. But for most of the people in the room, I suspect that's a very big, broad area to try and get sign-off. I mean, it's one of the things we, as accounting firms, have struggled with collectively is how do you get positive assurance that a big, complicated animal like GST is being run correctly everywhere from basic system setup through to proper use of tax codes by AP staff, through to proper assembly of BASs, and often in a situation where the tax function is not really given a whole lot of tools to work with. So I, for one, would like to have a much clearer picture about just exactly what it means to say that integrity of business system is a major focus for the year, and then having focused on it for the year, where does that take us? And for instance, the checklist is still a kind of voluntary guide. It's a self-assessment tool. What are we saying? Is that going to become expected that everybody does that? Would there be benchmarking of it? Where are you going?
Okay. All right, I might just stand up again. Thanks, Mark, to answer those questions. I think there's two elements to the question that you've asked. One is around integrity of business systems. The other is around governance and risk management. We don't see them in quite the same way, although we strongly recognise the linkages between the two. So integrity of business systems, if I might just comment on that one, is a risk that is easily preventable. And through the casework that we have done and through our general treatment approaches over the last few years, we have a documented list of drivers of that particular risk. And as I said, it is a risk that is easily preventable through upstream strategies. I'm going to sit down again. It is a risk that encompasses a lot of incorrect reporting and all the sorts of drivers that go towards that, and I'm sure you're all familiar with them. Human error, obviously, is a very big one. And then, of course, there are breakdowns in systems and controls. Staff changes is another factor where you have people who have key knowledge within the organisation and there hasn't been sufficient attention given to succession planning, and then those people with that key knowledge and corporate history move on. So our approach to integrity of business systems tends to focus on what we identify when we run our business rules models, when we run our risk models, and there are specific things that we want to explore. At a more general level, when we're working with the governance and tax risk management in that particular area and with the guide, we're looking at a higher level. We're looking more systemically rather than at particular areas that may have triggered our rules models. So it is a higher level. Now, the feedback that we've had in relation to the governance workshops is that businesses have found the process of preparing for those workshops rewarding and informative, and particularly where they've gone to significant lengths to prepare for the workshop and have used the guide in preparation, that it's been a really good opportunity for them to actually undertake their own review in preparation for the workshop. The workshops are generally relatively short, between a half a day and a day. Sometimes there are follow-up discussions and as I said before, action items coming out of those discussions. Sometimes they will translate into a walkthrough of BAS preparation or something else within the organisation that comes up as being relevant through the course of the workshop. But it generally is at a higher and more systemic level. I don't know if that answers your question, Mark.
It does to a point, thank you. One of the things we've observed is the increasing availability of off-the-shelf tools to enhance both the analytics, data checking side of BAS preparation, but also to enhance the preparation itself, the removal of, say, transposition errors, the creation of automated audit trails. There's at least 3 offerings in the market currently. One, and no doubt the good people at CCH would be happy I'm mentioning this. Can you see a point where the tax office starts to specifically endorse such a product? I mean, it's directly aimed at what you're trying to achieve.
We haven't had, as you know, a policy of endorsing products in the marketplace. Nevertheless, we're very interested in looking at those products, and we do appreciate working with the developers and those people marketing the products to actually take us through them and show us actually what they do and how they're built and how they're implemented.
I mean, I don't think it's any secret in a sense that each of those products broadly does pretty much exactly what the tax office's own computer-assisted verification tool does, except that it would be doing that monthly, which is a great enhancement for a lot of businesses like the ones in this room. But to get that sort of thing is a function of budget and what you're explaining to audit committees. Well, what's the upside from this? Yes, we're enhanced, but a kind of tax office, well, we're interested, is perhaps a little way short of what many of the people in the room would need in order to secure funding for such a thing. Hence and I'm sorry to be a bit pointed about it, but beyond that, we're just looking at more qualitative testing and the sorts of workshops that we've been having, where people prepare, yes, and they assemble, this is what I did and this is what I checked, but it's not exactly going through 95,000 lines of data to eliminate 15 error types. So.
Yeah. Obviously, the more that an organisation can do to get it right first time, the better the organisation is overall. It is much more costly for an organisation to need to respond to a review or audit because something has been triggered in one of our risk models. And so the investment in getting it right first time goes without saying. Any kind of preventative measure or preventative processes that prevent those easily avoidable mistakes is going to have some kind of cost reduction impact. So I guess it depends on what the organisation's starting point in terms of return on investment in those sorts of things. But particularly in large organisations, the more systems and processes that can be put around those things, and the more controls, the more opportunities to look for exceptions, etc., and do testing on a regular basis, the more the organisation can assure itself that things are working as they are intended to.
Sorry, I don't mean to hijack where you're going. Do you want to go back to...
Or do you want to present from here?
Yeah, I might present from here if that's all right. Okay, in managing tax risks, we do look, and this follows on from the topic we've just been talking about, we do also look for a clear demonstration of how the risk management processes manage specific risks. So it's not just those more general governance risks and integrity of business systems risks, but also the various strategies that are employed to manage specific areas of potential risk, and particular when there are events within the organisation of one sort or another that raise the likelihood of a risk occurring. In terms of the key risks that we're looking at, we've discussed a little bit the integrity of business systems risks. Can I say it's probably what we would call our second biggest area of risk in GST administration, and indeed we see it manifesting across the other indirect taxes from time to time as well. It certainly isn't hard for us to find mistakes being made which do amount to, in some cases, to millions of dollars. Surprisingly, even in the large market, it's not unusual for us to find errors that are in the taxpayer's favour as well. And what is worrying is that some of those errors aren't being picked up by the taxpayers. So it is an area where the more we focus on that area and the more we do, the more we realise that we can do, and the more we realise the value in upstream interventions there. And indeed that's what we try to do with publication of various information and tools and products. And we do intend to keep focusing more on upstream interventions. It's an area of risk that's ideally suited in many cases to what we would call lighter touch approaches as well, rather than needing to go straight to traditional review and audit products. The sorts of events that occur that contribute to integrity of business system errors are things like organisations that grow rapidly and their systems and processes, etc., don't keep up with the pace of their growth, where different accounting systems are brought together, such as through mergers and acquisitions, where the accounting systems are not integrated, where there may need to be a whole range of manual processes put in place in order to try and get those accounting systems to talk to each other in order to be able to go right through the BAS preparation processes. As I said, organisational restructures. Same goes in the government sector as well, with machinery of government change. It's very akin to the sorts of, there are very similar risks that occur in government organisations as well during those times. Businesses with out-of-date systems or inadequate control points are more likely to report incorrectly and indeed more likely to have triggers go off when we run our business rules models. Now, some of those can be dealt with quite simply and quickly through us making contact with the taxpayer and then going away looking at something and coming back with us. But sometimes it does point to the need for a more intensive review or audit product. The incorrect setup of accounting systems. Again, these things are very basic, and I'm sure you'd all agree they're highly preventable. Activity statement simple things like transposition errors that are not being picked up, that again may trigger one of our models. Claiming credits without holding a valid tax invoice or for non-taxable acquisitions. Excluding invoices produced outside the normal accounting system processes such as RCTIs, failure to clear GST control accounts. I mean, as I go through these things, it must be quite apparent to you how very preventable these sorts of mistakes are. So what is important is that, going back to your point that you were making before, Mark, that as much as possible, the governance and systems inside the business actually prevent these sorts of things occurring, or if they do occur, that they're picked up relatively quickly and that we are contacted, one of our CRMs or others are contacted, and we greatly encourage voluntary disclosures in those sorts of instances, as you know. I'll move on now and just briefly cover off financial supplies focus areas. This year, for the first year, you will see in the marketplace a change in our focus around financial supplies. Our strategies up to date have been largely directed at engaging with industry to identify areas of uncertainty and to work collaboratively to resolve these in order to assist and enable voluntary compliance. And we did have a particular focus on what we called a breakthrough strategy in the financial supplies area. The nature of financial supplies risk is such that we expect there will always be a need to work with taxpayers within the financial services industry to overcome issues which are presenting blockers to compliance. We do, however, think that we have reached a point where it is appropriate to test that what we have been told and to check whether treatments are consistent with the GST law. The testing will, in some cases, involve more detailed analysis than we've typically undertaken in relation to financial supplies in recent years. So this is a year where there will be some changes in our strategies, which we have outlined in the compliance program. We will also tailor our approaches and the extent to which work will be undertaken based on the nature of specific manifestation of the risk, the number of risks, the potential materiality and the categorisation of the taxpayer in terms of the risk differentiation framework. So once again, going back to the point that I made earlier on, depending on the categorisation, we will use lighter touch approaches or more collaborative approaches. Probably in most cases, that's what you'll see. In relation to apportionment throughout this current financial year, as you know, it's quite a broad area and involves a range of manifestations, and where possible, we'll be seeking to target specific manifestations of apportionment as they apply to the taxpayer. Examples of this include netting of revenues, apportionment in the context of credit cards, apportionment of branch costs, that's just to name a few. For apportionment, our focus will include both the basis for selection of the relevant method or methods, but also examination of the way in which these methods are applied through the accounting systems, and in particular, the relationship between the method and the specific acquisitions against which it's applied. We will be obviously also focusing on the area of reduced credit acquisition, items number 32, and also in relation to supply of rights used offshore. In relation to our real property risk area, again, this has been an area of focus for a number of years now, where we've made some significant investments in both our risk assessment processes, our use of external data, etc., but also working with industry quite closely as well. It's a broad-ranging area and has the potential, and the potential population may include any property transaction undertaking in the year ended 30 June in particular will be our focus over the coming year, and there have been around 350,000 identified property transactions that we are looking at. Therefore, our strategy is to ensure that the correct reporting of GST obligations by using a combination of the three main elements, obviously upstream marketing and education, also law clarification where it's required, and where we need to review and audit. And obviously we will continue to work closely with industry participants and engage with them to assist us in resolving any issues arising from complex GST provisions. Significant issues that we're currently focusing on include development leases, ensuring awareness and compliance with amendments to the new residential premises provisions that introduce the concept of wholesale supply, for some types of development lease arrangements, valuation issues, ensuring a non-monetary consideration and or margin scheme cost-based valuations are reasonable, apportionment attribution, resolving issues around arguable positions taken by taxpayers with respect to reasonable apportionment or attribution, entity structures, ensuring that the ATO views on tax law partnerships, non-entity joint venture, grouping, bare trusts, etc., provide certainty for taxpayers, especially in the large market where unintended GST consequences can arise due to arrangements that focus on income tax and CGT treatments. Although the large market represents only a small proportion of the total population of taxpayers in the property industry, this market contributes a significant percentage of the total GST revenue. So hence why we will continue to work with the large market and also we obviously continue to work a lot in the other markets using some different strategies there. Moving forward, in addition to our selective audit program, we'll focus on efforts in the large market to work with key clients around improving our understanding of their business environment. We will do this through the greater use of risk and also governance workshops, particularly where there are complex arrangements and or technical issues, for example, development leases, the treatment of property developments through GST group members or subsidiaries, etc. I know there's been a fair bit of interest around base erosion and profit shifting, and we indeed are working in that particular area quite closely with our income tax colleagues. We have people at the moment working on our strategies and our treatment strategies, undertaking risk assessments. Indeed, the OEC's developed an action plan to address base erosion and profit shifting, which has been endorsed by the Committee of Fiscal Affairs and the G20 Finance Ministers, which most of you will be aware of. In Australia, of course, these issues manifest quite differently on GST and income tax. GST is a tax on transactions, as you know. Taxation of profits derived from these transactions is not a consideration for GST for us in the GST business line. Base erosion for GST occurs primarily in business to consumer supplies and manifests when arrangements are put in place which defeat the connected with Australia rules for the final supply to the consumer. Again, we're really exploring a lot of our understanding around how some of the newer business models in the marketplace do manifest and the impacts on those business to consumer supplies. For low value imported goods, $1,000 or less, alterations to the supply chain are adopted so that goods are consigned directly to the consumer from offshore. Terms and conditions of this supply ensure that the consumer is the importer of the goods. The effect of this is that supply is not connected with Australia. No GST is collected on importation by customs as the goods are valued below the low value threshold for imposition of GST and duty. For services or intangibles such as digital content, the final supply is made from offshore rather than through a permanent establishment in Australia, meaning the supply is not connected with Australia. Our concerns centre on GST law relating to cross-border transactions often being complex and practically difficult to apply, structures being implemented that exploit the opportunity for no GST to be payable. If a business practical implementation of arrangements does not comply with the law, unforeseen GST consequences may arise. So nevertheless, we realise that we're operating in an environment of increasing globalisation and change in business structures, many of which are driven by a whole range of other commercial imperatives. So obviously it is a complex area for us to look at. We will continue to work closely with our income tax colleagues moving forward, but for us this is early days and we're still at an relatively early stage in the development of our understanding and our associated treatment strategies. Okay, that pretty well covers, I think, most of the things I had down to cover. So I'm keen that we now go to questions and commentary. Thank you.
Thanks very much, Karen. I think that should have got everyone excited with a few questions, but to give you a little bit more time to ask those questions, I'm going to hand over to each of the members of the panel to just make some comments on what Karen has just said, and start the questions. You've had a go, so Jacqui probably should go next.
Karen, you were making reference to the business rule models that the ATO is using in terms of identifying specific risks that obviously are mentioned when they come out in the risk differentiation ratings. I guess from the taxpayer's perspective, little is known around what you actually mean by that, and how that pans out, or what they should be looking at when that letter comes out to them. Are you able to give a little bit more guidance around, when you talk about business rule models, what exactly that means to them?
Okay. I think there's two elements to that particular question. One is the process that we go through for determining a categorisation for risk differentiation framework purposes. And the second part of the question is, I think, a broader question in relation to the risk models that we use to identify areas of risk across the full range of risks that we have on our register. In relation, so I'll answer the question in relation to RDF first. In relation to the risk differentiation framework, we don't use a single model as such at the present time. What we do is look across what is manifesting in all of our models that we use in all of the risk areas. So, for instance, we have different risk models in property, financial supplies, international cross-border, etc. They all have different models. So when we are looking at risk differentiation framework, we're looking at what we're seeing through not just those processes collectively, but we also use a range of other indicators that we look at to help us understand the taxpayer's risk posture and anything that may be contributing to an increased likelihood of risk. We look at things like whether rulings have been implemented, so whether the taxpayer has taken that ruling away and what they've done with it, for instance. We look at things like the degree of openness and transparency that is manifest through various engagement with us, willingness or otherwise to voluntarily disclose. There's a whole range of things. We've actually got about 15 factors that we look at as part of that. And it's actually quite an intensive process to bring all of that together for the purposes of what we call our annual moderation process. All of our risk owners are involved, not just one risk area. We also have our active compliance areas and our interpretive assistance and ruling areas involved. So it's actually quite a complex process, and there isn't a single model at this point in time, although obviously we'd like to be able to systematise more as we go on and continue to improve the way that we go about this. In relation to our risk models, many of them have been around for a number of years, but we continue to refine and enhance them, build further indicators into them each year. We also obviously invest in building, where possible, analytics-based models as well, and we will continue to have an investment in improving the various range of models. Obviously, in the process, as much information as we can provide to large market taxpayers around the sorts of things that we look at, the easier it will be for people to comply first time. So again, we are looking at a range of strategies now and into the future around all of that as well. Does that answer the question, Jacqui?
Yeah, I think so. I think it's just that, you know, from my experience with clients, when they get these letters across the table and something specific is identified, they often don't understand what is the ramifications of that and how is that being picked up. And so where do they start the process in terms of looking at it? So I guess the more information that can come out about how you've identified these particular risk areas, I guess would help for them to know where's the first place to start actually looking and addressing these things that you've written to them about.
Yeah. Well, I mean, obviously, in those sorts of situations, I would encourage taxpayers, your clients, to have conversations with us. Obviously, that's a really good starting place. Yeah.
If I could just extend the discussion around the RDF model and the factors that go into that. We know that there's two sectors. We have the upper right hand, which you don't want to be in, and we have the upper left hand, which is key taxpayers. Now, there must be a vast population of key taxpayers. You use 15 different factors or thereabouts to evaluate that, but it seems there's only one in that category, and there's, I don't know, 200, something like that, in that category. Are those 200 shaded across that sector?
Short answer is yes.
Right.
Short answer is yes. We do actually nuance the categorisation more than the simple 4-quadrant model. We've actually moved away from a strict 4-quadrant model, and in fact over time, as the risk differentiation framework continues to develop, and also we start to look through different lenses such as public versus private, we will start to nuance more as well. Each year we are each year we review what we're doing with risk differentiation framework, and it is becoming more sophisticated. So, so while we may have a broad category called key taxpayers, we also have key taxpayers where we do highlight concerns, and we have key taxpayers where we're not highlighting any concerns. So
is that going to be shared with the taxpayer? That they are left of left or right of left? Or
yeah, it is shared actually. We do share it. Right. The letters have been nuanced significantly in the last 12 months and will continue to be so. But I guess what we're recognising in the context of indirect taxes is that the majority of taxpayers do comply with their obligations, and so the way that taxpayers are categorised for our purposes, of course, is different to the way that income tax categorise those, and we recognise the validity of having separate categorisations for the different tax products. So, hence, as I said, in our first year, we recognise the need to nuance our response according to that population, which was why we sort of roughly had a middle category running through the model, which we called an assurance category. So not taxpayers who weren't actually right over on the right, but who weren't right over on the left either. And we're continuing to develop our approaches there. Thanks for that question, Rodger.
Denis, you haven't had anything to say so far?
No, I'm just a spectator at the moment. Two questions in a sense, or two observations and one question. The first one, I just wanted to just follow on from Mark's comments and I'll declare that we have a direct interest in this, given that we have one of the software tools that's on the market, as well as CCH. But these tools essentially designed to do the same thing, which is, you get numbers that come off your accounting system and reporting system, and these tools are all designed to, test the integrity of those numbers effectively. A statement from the tax office actually saying that if you have these tools in place, right, without actually endorsing any particular product, but if you have these tools in place, the impact of that is that you'll generally get a lower risk rating because it's actually doing the things that you expect, right? It's just not treating the numbers that come off the system as being sacrosanct and that's it, right? It's designed to pick up errors. That sort of statement in a document that comes out around the risk differentiation framework or something else, I think would be really useful.
Yeah, look, I hear what you're saying. I think the The reality is also, though, it's not just having the tool, which might be, more or less well designed and more or less well implemented initially. It's the ongoing maintenance of those tools, etc. So there are a whole range of things. Just because someone, it's like, having a fancy gadget in the kitchen. Just because you have it doesn't mean you actually know how to use it and using it to full advantage. So, look, I'm very happy to continue.
You can pick up that notion.
Yeah, very happy to continue conversations with you around that.
It is important because it is, that is essentially the encouragement for people to look at these things. Otherwise, it becomes a cost with no benefit, and you question whether that is an appropriate spend.
Yeah.
The second issue that I just wanted to raise is, we talk about integrity of business systems, but true integrity of business systems means that the taxpayers need to understand, what they're complying with and what the rules are. And at the moment, we have at least 20 recommendations from the Board of Tax on administrative changes to the law that are still waiting for amendments, and some of those have been self-inflicted by the ATO, quite frankly, right, in the way they've interpreted the law. We've got a whole bunch of stuff on cross-border, at least 8 recommendations that require, and none of these are actually on the horizon. Nothing will happen with these in the next 12 months to 18 months, if not longer. We have a whole bunch of other things that are still in change. We've had some changes to the tax invoice rules, which have actually made the system less flexible and more flexible. We just had the AP Group case come out the other day, which probably means there'll be changes to Division 134. It's sort of like there's this endless list that people don't, if you're caught in any of these positions, how do you actually get integrity in your business systems if you don't know what the rules are? And I guess the request for the tax office is, given we've got a new regime there now, is to almost start to interpret the law to give it greater effect from an administrative perspective, because it's usually when it comes to interpretation, there's a number of different ways you can go often. And also to work closely with Treasury to get some of these things pushed through so that then people do know what the rules are. Then they can set their systems up properly so that everyone can comply.
Yeah, certainly we recognise the importance of the sorts of things that you're talking about there, Denis. And indeed, we also recognise that there are areas where it would be good to have an additional number of guidance products out there. So I don't think there's probably too much that you've mentioned that we're not aware of and not working on in one way or another. Again, if particular taxpayers have specific concerns, much rather engage with taxpayers early on those issues and work collaboratively to try and provide greater understanding, greater certainty, and of course there are a whole range of mechanisms already in place for doing that.
Yeah, but we had changes to the rulings regime back in 2012, which actually meant that there's less and less public rulings that people can rely on, which, one, I don't think there's a lot of people who realise that a lot of rulings have been withdrawn. Secondly, if they did, then it puts more pressure on the private ruling system, which creates more work for the ATO. But where people don't realise that they've been withdrawn, they have no protection, and these things start to ripple back on each other, particularly when there's a lot of uncertainty. I mean, Mark, I think, described the process as a monster. It's a monster with a lot of thorns in its foot at the moment.
Yeah. Certainly hear what you're saying, and I'm sure you're aware that we've had this feedback before, and I hope that you do know that we are listening to it and responding. And certainly, I think it's no secret that we want to respond more quickly on a whole range of things as well.
Go on, you want another go?
I'll keep going all day.
Keep going,
right. I did want to go back just to the base erosion discussion, particularly around those businesses that are confronted with really a changing world, that the product is coming in over the border, purchased over the net, under the thresholds, and bricks and mortar retailers struggle with staying relevant, and they see falling revenues and legitimately, I think, ask themselves, well, is this distribution model going to survive? Now, yes, it says here that it's an area the tax office is looking at, but these people are dealing with this question every day, and the legitimate question they're asking is, well, if I shift to a different model, what's the tax office view on anti-avoidance? What I'm seeing in all of this is, well, tax office being focused on did the shift work, technically. What I'm not seeing in any of that is a clear tax office concern that if you move into a different structure that you're thinking anti-avoidance. Is that an accurate statement or not?
Look, it is an area that we have done quite a bit of work on in the last 12 months. One of the things we did in the last 12 months was look at the various business models that are in the marketplace and looked at how they actually played out. And what we found there was that the vast majority of business models are actually operating within the law and don't give up. And in that sense, we don't have a problem with them. The issue around base erosion and profit shifting is, as I said, it's very early days for us in terms of understanding how this issue manifests in the indirect tax context. It is a very different ballgame to what we see in income tax. Look, I can't say a lot more than that, except that when we have looked at the business, we've done quite a lot of work on that, and we still need to understand what we're seeing there, but we're not seeing the degree of problems that other areas see.
Okay. You wanted to go too, Rodger?
Well, I was just going to extend the conversation around base erosion in the sense that, sure, we have the onshore-offshore boundary, shall we say. Well, the other major boundaries within our GST regime are between those things that are taxed and those things that are GST-free, so food, education, medicine. Is there a focus on that dimension from a base erosion point of view, or is that considered to be not that significant in terms of a risk versus, shall we say, the offshore boundary risk?
Yeah. Look, as I said before, it's very early days for us with this. We are still doing our risk assessments. So for me to comment in too much detail at the moment wouldn't be appropriate because we've got a lot more work to do. Very, very early days. As I said before, we're interested in business to consumer. A lot of what happens in the large market is business to business. But we will, as we move forward, as is our approach with other strategies that we have, we will engage with the marketplace, with industry and with yourselves around those strategies as we develop them further.
I'm going to butt in now and have a question myself. You mentioned, Karen, the tax gap, and it's something that's always been intriguing me, particularly when you come up with a number of 5.4% and it's down from 10.7% because of ATO activity, and you're thinking, well, yeah, that's good, but what is it?
Oh, gosh. I can't profess to be a specialist in tax gap. Look, we've got a lot more information available through the annual report and through the website on the methodologies that we've used. The methodologies that we've used in Australia are similar to methodologies that have been used by other jurisdictions. And in terms of that, we're actually quite confident using a range of data sources and a range of information that we are, we've come up with a reasonable and defensible calculation for determining the gap. Now, I would have to get my economist colleagues to explain the methodology to you in much more detail than that. And if you are interested in a more detailed presentation, we can certainly look at that. There has been more detailed presentations to some forums in the past.
Thanks, Karen. So now it's probably a good time to open the floor to questions. If you have a question, please raise your hand. Please wait for the microphone to arrive, because with a webcast it won't work if your question isn't heard by the webcast. Could you please say your first name before you commence your question?
Okay.
The gentleman up the back is... sorry.
Yeah.
Yes,
My name is Pat. The question is for the rest of the panel. If you were putting your recommendation hat on to Tony Abbott for GST going forward, would you recommend no change, an increase in the rate, or a broadening of the base?
I'll happily go first. Yeah. My answer to that would be yes. From an EY perspective, we think there are plenty of inefficient taxes that impact adversely on business decision making and investment, and that we could clean up a lot of mess by increasing the rate and or the scope of GST. You know, relative to the size of our economy, our GST is fairly paltry in terms of what it brings in. You know, it's an awful lot of mechanism to be bringing in the sort of money that it's currently bringing in. You know, we make no bones about that.
Look, I think the answer is you want to increase the rate, broaden the base, and then the question is by how much. And whatever cash you get out of that then allows you to either get rid of inefficient taxes, reduce corporate tax, reduce income taxes, and compensate low-income earners and self-funded retirees. I mean, that's what happened when the GST originally came in. It was part of a whole tax reform package. The reason that it was relatively, it got through effectively was because it was revenue neutral. Every time they keep talking about increasing the rates, the states want to spend more money, so presumably any increase in the rate and broadening of the base won't be revenue neutral, and that'll be a much harder thing to win the electorate over. I think it's as simple as that. Mark's dead right. The proportion of, if you look globally, the amount of taxes that are coming from consumption taxes have been increasing and have been increasing steadily as a proportion of the tax take of most European and most developed countries. Australia's stayed at 10% with a number of exemptions since 2000, so we're sort of lagging behind. If you have a look at the numbers, we're actually, as a proportion of the tax take, we're dropping further and further behind most developed countries. So it's like everything, we can talk about the economic theories and then we can talk about politics, and somewhere in between you're going to get a balance.
And from a Deloitte perspective, that would be pretty much where we're at. That there's a case for both, but it has to be done in an environment where there is some degree of trade-off vis-a-vis the inefficient taxes that exist within the Australian system.
And from a KPMG perspective, I think we'd agree with that as well, because our experience has been, just as you've heard, it's a relatively inefficient tax. It takes a lot to comply with, in terms of your systems, your processes, your training, your ongoing maintenance, all of those sorts of things. But the minute that you put the rate up or you broaden the base, then obviously there's all sorts of social issues associated with that. So there has to be a balancing act.
And I think from a corporate perspective, I'm not part of the panel as such, but I think I'd be against any change because it's going to cost a lot in terms of compliance to upgrade your systems for a new rate or a broadened base. So it might help the advisors a lot in generating fees, but it doesn't exactly help the corporates in terms of managing their tax budgets. Sorry, Mark.
Okay. I can guarantee you, Peter, that any decision to broaden the base or increase the rates will have nothing to do with our fee opportunities or whatever.
Any other questions?
I don't suppose the tax office would like to comment on that question.
I think you know the answer to that one, Mark.
Okay, I can't see another question at the moment, so I'll ask another one. Now, you've talked about the risk and governance workshops, and you said that they vary in time from half a day to a day, but there are other factors that also vary, and that's the amount of preparation that clients go to, and also the attendees that go to these workshops. Would you like to make a comment about that?
Oh, look, that's quite correct. And what we've observed is that taxpayers do take different approaches to how they engage with us for the workshops. By and large, though, we're increasingly pleased with the level of engagement and the level of willing collaboration through the workshop processes. We're getting feedback that they are beneficial, that they have been useful for a range of reasons. And so while there was an initial reticence, particularly in the first year, and we received some commentary around them being less effective, I think over the last year the feedback and commentary has definitely been that there is a recognition of the benefit of them and the usefulness of them, and the investment that goes into preparing for them obviously will directly impact on the usefulness and effectiveness of them as well. It's a decision for taxpayers what they choose to invest in preparation, but we've been very impressed with the level of willing engagement, particularly over the last 12 months as people have understood what we're doing more. Yeah.
Who would generally attend from the client's perspective? Well, that probably varies a lot too.
It does. It does very much vary, and again, that's something that we're happy to negotiate on a case-by-case basis and discuss. Likewise, depending on the nature of the workshop, if it's a risk workshop, they're all tailor-made. So it may well be that for some of those workshops, we'll actually take along our technical experts for the workshop. So very much they are discussed collaboratively, and to a large degree the conduct of those workshops is agreed, mutually agreed.
Okay, thank you. Now, those that are on the webcast, I have got this device here that questions can be asked as well, so there may be some that come from there, but Thomas got a question.
My name is Toma Kudrich. It's a question for Karen in relation to governance and tax risk management. Just curious, I understand that ATO expect evidence of advice from external advisor being sought on unusual large and complex transactions. What do you actually expect to see from taxpayers having regards to legal professional privilege and accountant's concession? Is it that just our response being, yes, we have, or no, we haven't? And where do you get from there?
I think the important thing to emphasise here is that what we're looking for is that where there are unusual complex transactions, that due regard has been given to what is the right treatment for that transaction. And where the matter is outside the capacity, capability of the organisation, that they show that they have done, they've done what they can do to ensure that they are able to get it right. That's really essentially what we're looking for there. We're not looking for specific pieces of actual evidence, so to speak. It's more, if you think about it in terms of what are we trying to achieve here, we're trying to ensure that the processes that happen within the organisation around those transactions are solid ones with some level of rigour and integrity.
I have a question. It's not sort of strictly following this agenda, but I gather it was asked in each of the two previous ones, so just for completeness we should cover it. Tax Office attitude to input tax credit accelerator products, for want of a better word.
Yes. I am aware that this question has been asked at, I think, most of the seminars that we've conducted, and the response that I'll provide is very much the same response that I think has been provided elsewhere as well. It has been a review which is almost complete. We are very close to wrapping up the review. It has taken longer than we had hoped, Mark. Like a lot of other things, sometimes the more you get into the detail, the more complexities you come across. And so we are very close. We are expecting to have something back out to you, to all of the big four firms that have worked with us on this in the next fortnight. So we're very close.
I think that doesn't quite go quite as far as the previous answers, but broadly it was a positive answer, I thought.
Again, look, I think one of the things I want to say here is that we value working with you on these sorts of issues. We value being able to work jointly, talk about issues quite openly and frankly, and to be able to move forward on where we go with these sorts of things. With this one as well, once we finalise the review, what we would hope is that we can continue to work together in this topic area. And the more that we can do that, I think it's to all of our advantage, really. Yeah.
Okay, the questions aren't flowing. I thought they would be. So, here's one.
Hi, my name is Jimmy. Just a quick question on the RDF. I understand that not all businesses have received a letter stating which quadrant that they're in. Could we assume that if you haven't received a letter, that you are in the low risk category? And also, you said you're still refining the risk model of it being developed. Is there any guidance for businesses to sort of ascertain at where they would ascertain which quadrant they would be in?
Right. Okay. We have a limited population for the risk differentiation framework. So not all taxpayers go through that particular process. So if you haven't had any engagement with us to date on risk differentiation framework, it's either because you're outside the population, or it's because we haven't yet sent out the letters for this current year. So we have had some new entrants into the population, and obviously those people will receive a letter for the first time. But if your business is roughly the same as it was last year in terms of size, etc., it may well be that you're not in the population. Now, I can't answer specifically in your case because I'm not sure who you're with, but what I can say is that we do have specific criteria for who is in our large market population for RDF purposes.
I've got another one. Lots. As at this moment, I think there's only 18 taxpayers who have advanced compliance arrangements in place with the ATO. One of the advantages of those agreements, or arrangements, because we avoid the word agreement, is the annual clearance letter. Tax office saying, right, because you've met all the requirements under this arrangement, we will not audit that year. That's a fairly potent thing in a positive assurance sense to be handing over to an audit committee. 18 out of the sort of large base, it's in the order of about 1% at the minute. Given the focus in the coming year on moving more pointedly into process systems and looking at that side of things, can you see there being a lot more of these ACAs being offered to taxpayers?
Short answer would be yes. Again, our strategy around ACAs continues to refine and develop as well. And we have aligned our approach to our risk categorisation framework and the types of interactions that we want to have accordingly. We did some time ago publish on the website some information on ACAs, because what we found was that there was some misinformation out there based on some early experiences with ACA entry processes and the resource investment that went into maintaining an ACA arrangement. We have since significantly changed those requirements, but the word hasn't gotten out as far as we'd hoped it would. So we're going to be using a range of different approaches because obviously there are a lot of advantages for people in having an arrangement like that in place. But they will always be a premium product where it's aimed at a particular part of the market. But as I said, our strategies around that at the moment are also being looked at, and I think Les de Wind, I'm not sure whether Les de Wind has provided some additional information there as well. But yes, the short answer would be yes, we'd like to see more.
Going on from that point, you mentioned lighter touch products, lighter touch collaborative products. Would you like to expand on that a little bit and explain what those products might be?
Okay. Our products, our suite of approaches for interacting with taxpayers continues to evolve and develop. Last year, we had 5 products, 2 of which were the workshop products, so a risk workshop, a governance workshop. We had a product which was basically based around an outbound phone call, where it was a light touch phone call to verify a question that we had, to get an answer on a question. Also, we had a field visit and also a correspondence product as well. Now, they're not like our traditional review and audit products in that they're much shorter, sharper, and enabled us to have an interaction with a taxpayer and for them to come back to us with whatever response it was or level of assurance that it was. So in that sense, we call them assurance products, but they were light touch. Now, in terms of where we go forward in the future, we're going to be emphasising service and upstream support and assistance, and continue to look at those further upstream, less costly interventions, so that, as I said before, we can assist people to get it right first time. If we have a question, we can get those issues resolved much more quickly and without the same degree of cost of compliance. So that's kind of what I mean by a lighter touch. It's all about us being able to work together more collaboratively, shorter, sharper resolution of things. Yeah.
Those are very much welcomed by industry. I'm not seeing any more questions. I'm not seeing any questions here. So I might ask one of the panel to... Well, Rodger's looking very keen.
I've got a question.
Go for it.
One of the things I'm interested in is the impact, perhaps, or otherwise, if not known, of the development of the RDF framework and the tax gap. Right? Has the development of the RDF framework at all impacted the tax gap? You've made the comment on your slide that active compliance have reduced the tax gap. Is there any evidence or research around the impact of the RDF? I mean, really, the question is, what impact is the RDF having on corporate behaviour?
Yeah. We are looking at measuring the effectiveness of the implementation of the RDF. We've already had quite a deal of feedback, and we've already been able to observe a range of changes in taxpayer behaviour with greater levels of engagement and a willingness to work with us more, depending on the taxpayer's categorisation, but also it differs across the taxes as well. And but in terms of formally measuring the impact, that falls into the category of what we'd call effectiveness measures. And yes, we have been talking about the effectiveness measures and looking at that over the past 12 months, and indeed having conversations with large market taxpayers themselves and also representatives around how we go about really, getting to measure that level of impact.
Okay, mindful of time, I might ask you to raise that question afterwards because we need to stick to our timelines. From my perspective, thank you to the panel and to Karen particularly for all the presentation and support in making my chairman's job a little bit easier. And Russell would like to say a few final words.
Thanks very much. Thanks, Peter. So, Karen, on behalf of, and to the panel, on behalf of CCH, we do have a few gifts to hand out. Karen, I understand this will go into the social club raffle. So thank you very much. Thank you to the audience and to everyone via the webcast for attending today's event. As I mentioned up front, as a gentle reminder, if we can get you to complete your feedback forms, predominantly around the content you'd like to hear from the panel or other speakers during upcoming events. So once again, thank you to Karen, thanks Peter, thank you to our panel for your attendance and active involvement today, and thank you very much to the audience. Enjoy the rest of the day. Thank you.